Welcome to the Daily Block, the top events happening in the past day in crypto and why they matter, served with a side of sarcasm and a sprinkle of gamma squeezes. Bitcoin and Ethereum ETFs bleed $439 million. As options traders, brace for more downside. Spot BTC and ETH ETFs dumped about $439 million in outflows on Monday, with Bitcoin funds leading at roughly $363 million and Ethereum funds about $76 million. That wiped out much of last week's inflows as traders repositioned ahead of Fed noise, inflation prints, and a big options expiry. On top of that, more than $354 million of leveraged crypto positions got liquidated in the last 24 hours. Short-term deleveraging is doing the heavy lifting here, not macro fundamentals. Why it matters for crypto investing, ETF flows and derivatives deleveraging. Move price fast, persistent outflows plus high leverage means the next options expiry could amplify a pullback. Risk counterpoint. If macro prints come in friendly, flows can reverse fast and fuel short covering rallies. EF inflows can be a shock absorber on the other side too. Next up, the BlackRock wallet moved $980 million of Bitcoin, 300 Bitcoin chunks, and the market barely flinched. On-chain watchers spotted roughly $980 million worth of Bitcoin moved in multiple transfers of about 300 Bitcoin each tied to wallets associated with BlackRock's iShares Bitcoin ETF. BTC dipped briefly and then held, which looks either like a well-timed custody reshuffle or a stealthy liquidity test. When BlackRock moves big piles, traders start reading tea leaves. Why it matters for crypto investing. Any large ETF wallet movement tests liquidity. It could be custody, redemptions, or selling, and these moves have triggered outsized intraday volatility before. Risk counterpoint. If this was just custody logistics, it's noise. But if it's a prelude to redemptions, be ready for more chop. Whales went full panic mode on alt tokens. ETH, Hype, Pump, and Aster got wrecked. Several whale addresses dumped heavy loads. About 1,000 Ether, roughly 56,500 Hype for $2,700,000, and 307 million Pump tokens for about $1,700,000. Aster, a celebrity-backed project, plunged roughly 30% after high-profile entries, and analytics flagged a pattern of buy high, sell low whale behavior that smells like late-cycle capitulation. Meme and IDO tokens are the crack cocaine of volatility. Great highs, brutal exits. Why it matters for crypto investing. Whale capitulations can cascade into liquidations in thin markets. Altcoins are especially fragile, so watch whale transfers and exchange inflows carefully. Risk counterpoint. Not every whale sale is bearish. Teams, VCs, or market makers rotate positions. But in microcaps, the sell pressure is magnified. Zero Hash raised $104 million from Morgan Stanley, SoFi, Apollo, and Friends. Institutional rails getting deeper. Zero Hash closed a big round from heavy hitters to build custody, trading, and stablecoin plumbing for financial institutions and fintechs. This is not flashy meme coin money. It's plumbing for the kind of capital that moves towers of Bitcoin without breaking a sweat. Wall Street is funding the scaffolding to let more institutional capital cross the bridge. Why it matters for crypto investing. Better institutional rails reduce frictions for big capital entering crypto, which raises baseline liquidity, supports larger tokenized product flows over time. Risk counterpoint. More institutional access increases sophistication, but also correlation with risk assets. Liquidity is good until everyone hits the door at once. SafePal integrates Aster Perp DEX. 25 million users now have native access to 100 times leverage. SafePal, the wallet used by about 25 million people, added native Aster perpetuals across BNB Arbitrum and Solana, offering up to 100 times on BTC, Zenitsu, ETH, and 50 times on tokenized stocks. Aster already saw massive early volume and an airdrop, and now retail leverage is clicking right into millions of wallets. Imagine every meme trader having a turbo button for liquidation porn. Why it matters for crypto investing? Wallet to perp integration massively widens retail leverage access, so expect bigger volume spikes, faster whipsaws, and more retail-driven squeezes. Risk counterpoint. More leverage drives both explosive rallies and brutal washouts. If you trade perps, liquidity can evaporate in the wrong direction. Quick breath. Now a trader drew the line in the sand for BTC, $108,000 to $120,000. Popular pseudonymous trader Immortal flagged a clear regime. If Bitcoin sits between $108,000 and $120,000, alt exposure is a rules game. Below $108,000, alts get hammered. Above $120,000, multi-week alt season could kick off. He also pointed out an ETH gift buy zone and called MNT an outperformer after it held support. Why it matters for crypto investing. High follow trader rules move retail positioning. Use that range to size alt exposure and set stop entry frameworks. Risk counterpoint. Crowd followed levels can be self-fulfilling and then violently reversed. Use proper risk sizing, not fandom. UX Link got hot and then cold. Attacker minted 10 trillion tokens and then got fished mid-exploit. The UX Link multi-sig was crushed in an exploit that resulted in over $30 million lost. The attacker minting about 10 trillion tokens and dumping them into markets. Chaos followed. Prices crashed more than 90%. Then a partial recovery narrative popped as the attacker themselves got fished and some funds drained. The project is planning a token swap and audits, but trust evaporated fast. Why it matters for crypto investing. Newly minted tokens and sloppy multi-sig setups equal irreversible losses. Don't FOMO into hot mints or free airdrops without on-chain risk checks. Risk counterpoint. Some projects can rebuild trust post-audit or do fair swaps, but the timeline and legal fallout are messy and often disastrous for early buyers. Finally, BitGet just nuked listing fees and expanded BitGet on-chain to millions of tokens. BitGet announced it's doing away with token listing fees and opened BitGet on-chain to instantly support millions of on-chain tokens across Ethereum, Solana, BSC, and Base, plus AI signals for whale and wallet activity. Removing the gatekeeper makes it absurdly easy for new tokens to hit retail order books and for meme projects to find liquidity in seconds. Great for FOMO traders, terrible for rational due diligence. Why it matters for crypto investing. Lower listing friction means more microcaps, faster listing pumps and dumps, and a noisier market where on-chain signal filters become essential. Risk's counterpoint. More listings equals more alpha if you can sort signal from noise, but it also ramps up rug risk and scam velocity. All right, that's the rundown. If you trade, watch ETF flow prints, derivatives open interest, the BlackRock wallet trail, whale exchange inflows, SafePal/Aster volume spikes, and the $108,000 to $120,000 BTC regime, because the market moves on flows, leverage, and meme momentum, in that order. Subscribe for the daily dose of chaos, data, and snark. That's today in crypto, where the gains are imaginary and the pain is real.